because it's disappeared on the screen into more. So that's starting the recording going. So can you see the tab there?
Yep.
Yep. Excellent. So this is a spreadsheet model, and along the bottom you can see there's process, which is just instructions. I'm not going to go through that. That just tells you. So you'll get a copy of this model that has the instructions in there. You've got a next tab is a sample profit and loss account. This is how it would look like when we send you pre-populated information. It will take your how your zero is already set up between your sales nominal ledger structures, and it will just copy that and repeat it. And the same with your balance sheet. It will show you the figures that you've got in your balance sheet as it's set up in your zero. So what we do is then we pre-populate this information, and you have to go in. So here's your is an example. We've set up some figures in advance, but where it's blue, it allows you to go in and change. So you see the sales figure there. So when you go into sales nominal, you've got a little drop-down key that will say to you, right, it's either sales, it's either cost of sales, or it's an overhead. So you would put down, this would actually reflect whatever you have got in your zero. You've got to choose whether it's sales. Now, generally speaking, it's going to be sales there. But if, for example, you've got a description in there, a total column that you didn't want to use, if you use select category, so sales nominal ledger number 9, if I went to put there select category, it wouldn't appear on my baseline forecast if I was looking at it, because when we're looking at the model, so when I go along to the baseline forecast, sales nominal 9 now doesn't appear. So all I'll do is I'll go and revert that back. So these are just questions of category saying, they're either sales, they're cost of sales, in other words, direct costs. So in your terms, Taleb, it's going to be cost of medicines, cost of wages, are going to be your direct costs in there. Yeah. Okay, and so these will be direct costs, and then you're going to have your overheads. So things like totals are just going to be shown as select category. They're not being shown there. This is just information to pre-populate your spreadsheet. You have to put in your company name. So you go up there, and we just called it demo company, but you'd put in your own companies in there, and you put the first month of your year. So the latest month. So if you're starting, your year starts in April, you put that as an April, and then it would populate. So if I change that and said, so Taleb, yours would start in November. If I start it, everything then changes. It doesn't match it, so because it's already been set up, but the model would change automatically. Okay.
Yep.
Closing balance sheet. We go on to that, and that literally is the last opening balance sheet that comes off your zero. So again, will be pre-populated for you, and your drop downs. It's either a fixed asset, it's a current asset, a current liability. So current asset is money that you have or is owed to you. Current liability is money you owe. Long-term liability is like mortgages, and then you've got shareholder equity. So it's just saying this will all be done for you, but the reason why it's relevant is, for example, a bank account might be a bank overdraft. It might be, if you normally have a bank overdraft, you would say, well, that's not an asset, it's not something I own, it's something I owe. So I would change that to a current liability. But I won't bother changing that at the moment. But that's the only reason why it's important to share this information with you. This is all setting up, it will all be done for you. Okay, so then we get into our baseline forecast. Now here, in this example, there's 2 years worth of information starting in 2018. Okay, what I do is, let me just, so that you, in case you have calls, what I'll do is I'll mute you so that you can take calls. Okay, and then you can still hear me. So, you okay? You can hear me, Leslie. If you won't wave your hand, you can hear me. Yeah, great. Thank you. So, 2018 history there, just coming straight from your zero, month by month by month. 2019. So the new year starts in 2020. So from April 2020. So it's taken all this information. It's also taken your cost to sales, your direct costs, and taken all this information. It's all history, and that's all it is. It's history. It's for reference purposes. And then it's taken all your overheads. So exactly the same as you've got it in your zero. So it's taken it there, and it's got some spare lines. So if you know when you're doing your forecast, you're going to have some new overheads that you're going to be incurring, it just gives you a chance to enter them in here. Same with new types of cost of sale, and the same with new type of income. So that it would allow you to forecast ahead. The whole point of having this is to allow you. This is the history. This is the new stuff that you can put in when we get to 2020. So all your history has been pre-populated, and because this is just a demonstration figure, what that's showing is that last year the figure was these were the totals of line 6 for sales nominal 1. This year as 215,081, 204,839 the previous year, a year-on-year percentage increase of 5%. Well, surprise, surprise, each quarter there's a 5%. So everything has been done at 5%. It's just a demonstration. Your figures would be different because they would reflect reality. So this is just a reflection of your history of what it is in there. Now, the idea for this demonstration set of information is we're assuming lockdown in March, there's not going to be any income coming in. Now, obviously, that's totally different for you, Taleb, because you'll be having loads of people coming into you in the care home. So, but in Leslie's case, in a lot of cases, income just sort of stops or reduces dramatically. In this case, it's a hospitality business, and so we just said, right, you've had to stop trading. So we've taken out all sorts of all the income between April and July, and then started some in August. So you can put in whatever figure you wanted. So if you wanted to put in whatever it is, so this is like trying to do a forecast. So if you were saying, right, we're forecasting from July onwards, we could use that to put that in, and then that would reflect in the totals going forward. So it's just there for you to put in anything in the year ahead, because this will not be populated. You would have to put the figures in there for yourself. So same with cost of sales, takes the figures, and if you wanted to say, right, I'm taking my history and I'm looking to increase it by 10%, these costs, I'd put in 10% here, and it would reflect in the figures. So if I was saying, right, I'm going to go 10%, you'll see here 2960 is doubled. The figures have changed. So 2621. So if I revert that back, where's my revert button? Let's just put it back there. Where's my revert button? There it is. The figures have changed back to 1463. So all the formulas are in there, so that you change. But in a lot of cases, you won't be using this button at all. You'll just be putting in figures along here. So these are all formulae. You just put in, you can overwrite the formulae. It's up to you if you want to put in the figures that are relevant to you each month for each line. So that could be wages, that could be cost of medical equipment, that could be cost of PPE, could be cost of software, software design engineers, whatever it is. That's what you'd have in your figures. Then you'd have your overheads. You'd literally go through and you'd work out your overheads, and you'd put in the figures across month by month by month in there. Now, for Leslie, the only thing I just need to draw to your attention is the VAT column right on the far side, where if you've got, say, for example, wages, there is no VAT on there, but rent, there might be VAT, depending if the people have opted to tax, or there won't be VAT. So you put whatever the VAT element is in there, you put that in, and then the system will say whatever figure you've put in there will calculate the VAT based on that line. You can unmute yourself anytime you want to. I've put that, so if you've got any questions, just interrupt me. Feel free to do so. So you go and put your overheads in here, and so they just become your reality. If you've got any new overheads, bad debts, always make sure the bad debts are in this line. Don't go and create a new bad debt line. So that would be the figure. So if you suddenly say, I've got, in your case, Taleb, you've got Mr. Jones in room 33 and has died, and the solicitor said they had loads of money, but they've got no money, so you're not going to recover the money. That would become a bad debt. You want to reflect it that in there. You could put it in there, but always put it on that line there. Any other new overheads, you put them in, just enter the figures, and you've got your totals, and you get your net profit. So what happened with this business? They had the net profit in the previous year of 206,000. In this last year, 247,000. The net profit percentage. This is all history, and then you've got all your figures, and then you start working through there, and that comes with a reflection. You say your total for year one, and you put your figure in there, and you have your year-on-year percentage. You've got your cost of sales, your direct costs, as I prefer to call them, your different wages there. So whatever you put in there is going to reflect in the totals. And at the moment, so the overheads they're 305 because the income's dropped out. There's showing a loss of 117,000. You then go on to the year after. So again, you can put a percentage or you can put in figures. I recommend you put in figures rather than being percentage. So you think about it. So the forecast for year 2, months 13 to 24, put in the figures for your income, put in the figures for your direct costs. These give you the totals, and then put in the figures for your overheads. It's a bit more laborious, but it means you're looking at the figures and dealing with it direct. And that's showing you, okay, with a bit of income there, we're actually going to make a profit of 184,000. So not as good as the year before this last year, but still a big increase. And then for year 3, 4, and 5, we're just not taking it month by month. We just put them in. So this is where you might want to use percentages, because rather than putting in figures monthly, you might say, right, I'm going to put, I think on sales nominal 1, I'm going to put a 7% increase. And you'll see 128,000 change to 130,850. If I wanted to put a 3% increase in year 4 rather than 5%, you'll see 137,000 changes to 134,000. So it's literally just a model. You can't do anything wrong. You just save a copy, and you have that as your one version. So if you want to try different versions, you just save one as a version 1, one as a version 2, one as a version 3. So you can try different versions of different growth models. You put in your year 5, VAT, Leslie's case, unless it's an export, is going to be 20%, and in Taleb's case, you're not going to have any VAT. So in Taleb, you just have 0% on there. So here, these are all the figures, and they just produce your net figures. And so you'll see coming down here, net profit, and year 3, 214, year 4, 242, year 5, 272. So at that stage, we can say, well, that's great. Do I want to produce, if I could just go and produce a report, a forecast report, and it will give me my figures. I could then go in there and just produce, this is what my forecast is showing me. and it'll produce me a whole load of nice graphs showing me that information. But we want to actually, we're saying here, actually, we're going to need to apply for some funding because we've had a whole load of income disappear. So we need to try and look at it from a slightly different way. So we're going to look at a baseline three-way forecast here. And we're saying, right, let's look at depreciation. So I take you back, just make sure I haven't lost you there. So these are your closing balance sheet, your monthly, so the history, taken into your baseline forecast here. Your baseline balance sheet is taken from your figures, automatically pre-populated, so you don't have to do anything with that. And then we go into your baseline three-way forecast, which has taken your profit and loss items from this sheet here, and you'll see those first 4 months, nothing in there. So if I'd gone and put in baseline forecast, if I'd gone and put in there £1,000 in May, look at that base. I'll go to my baseline three-way forecast. That £1,000 has suddenly appeared. My cost of sales as a percentage has appeared, and so that's shown in my forecast. So I'll leave it as it is just to demonstrate it. It's only a small figure. So at the moment, we've taken our figures there and just summarised them into a profit and loss, a balance sheet, and a cash flow forecast. So it's actually taken our figures and taken as a cash flow. Now, we know nothing's quite so simple. So what it's saying is, look at the depreciation from the figures you put in, from the history on your zero. Now, obviously, it's only as accurate as the quality of the information you've put into zero. So say that quality of that information is good, then this is suggesting that you've been working at a depreciation rate of 32%. Now, let me just demonstrate the balance sheet where you're looking at your fixed assets. You look at your cash, your accounts receivable, your goodwill, intangible assets, and your fixed assets, 24,324 here. You see, if I go and change that to 25%, the figures right across the top change to 25%, and the fixed assets have changed because it's working out the depreciation for you. So revert it back to 32%, just leave it at that. If you've got any borrowing, in this case we had £10,000 worth of borrowing, or £5,000 worth of borrowing, sorry, let's just take you back to your balance sheet. Your balance sheet, you had a bank loan of £5,000. Now, wouldn't that be nice that we just have borrowing of that low? So go back to our baseline three-fourths, that £5,000, what is the interest rate you're paying? Well, you've been paying at 7.9%. I'll leave it at that because it's the same loan, but we've got to put in what the cash flow. So what we've done is repaid that £5,000 over 2 months, 2,500 in the first 2 months. And then you'll find that the loan, if I go down to the balance sheet, as a result of me putting those figures in there, the liabilities in terms of loans, debt 2,500, 5,000 it started with, down to 2,500, down to nothing. So the system will work it out for you depending on what you're putting your figures in. It's also looking for stock. So in this particular example, hospitality like a bar, you've got an amount of days stock. Now, most clients I deal with, even in the bars, don't work in inventory days. So what they do is they'd work out roughly what sort of stock figure, and they keep it reasonably constant. So unless, say, a Christmas or a holiday season, they stock up and they make it higher. This allows you to alter the number of stock days, so what they call inventory days. And in this particular, it's saying my stock is going up 175, 192, 233, 240 before it starts coming down again once we start selling stuff. Corporation tax liability, we had 15,000 that we owed, and we're going to pay that in 9 months' time. So we put the £15,000 payment in 9 months' time. It was a March year end. we're putting down a payment in 15,000 at the end of December. Dividends, most important, we've put in there £1,500 a month. Now, year 2, it's gone up to £2,000. It is whatever figure you want to put in. This is your model to put in whatever you want to do. So I'm suggesting you probably are not going to mess around with inventory days. Depreciation, you'll be able to, if you're not sure, come and talk to us about it. Again, corporation tax liability, that's reduced. They're saying £10,000 is going to be paid in March, but the £15,000 is there. Corporation tax, if there's any additional amounts payable, you'd put them in there. So if you're saying, right, I'm going to I've incurred profit, you just have to work out what the tax will be. We can let you know what it is, and you just put it in there. Capital expenditure, say you're going to incur any capital expenditure, you put it in here. So like we've put in there minus figures for repaying the debt, you're going to spend money out, you put it in there. Here we just put in £4,000 a month, starting in August. It is what it is. So you put in whatever the figures. But these then are going to be reflecting not only in the profit and loss, if there's interest, say for example for 2 months, it's going to be reflected in the balance sheet where we've added new assets. So the assets increase, less the depreciation, and it's going to be reflected in the cash flow. So whatever figure we put in there is going to be reflected in the cash flow. Now, Taleb, there's a VAT calculation. You don't have to get involved in that. Leslie, you have to look at your VAT account here at the bottom. And so you have to decide, right, what period is it here? January, April, July, October. So you choose which is your cycle: February, May, August, November, March, June, December, and just put it in whatever is relevant in there. We'll leave it as October, and then that will work out your payment cycle for you. So depending on whether you feel your money that's owed to you is going to be slower or quicker, you put in your figures here for your debts. So in this example, we're assuming people are not going to be able to afford to pay. So we've said of all the debtors that they had, they've got 76,000 owed to them. Only 15% is going to be received in April, 15% in May, 15% in June. In Taleb, in your case, you're going to be, you shouldn't have lots of money owed to you. Leslie, I'm not quite sure what your position is, but you just make it relevant to yourself. And so whatever figure you put in there. So if we look at the closing receivables here, if I said I'm going to change that up to 30%, you'll see my 64,984 down here is going to change to 53 because we've got more that's actually been received. So that figure has increased. So if I put that in there, it reflects that, and then it reflects on the cash flow. Same with the money I owe, the amounts payable. How much of the bills that I owe 57,000 at the end of my previous year, how much of that, opening payoffs 57, how much of that is going to be paid? At the moment we said 25%, 25%, 25%. And it's not until October we start increasing the amount of money. So put in what's relevant to you, and then you've got your figures, and you can make it relevant, and then just test your figures and say, well, how does that impact on my cash flow figures? Now, it's giving you some statistics for reference purposes there, and you'll see the impact on the cash balance. So if we change the figures down at the bottom, it will impact on the cash balance that we see here. So let's have a look at the cash balance and say, right, how are we doing? Well, because we've got no income, it's fallen out and we're picking it up slowly. We're going up to 100,000 overdraft, 127,000 overdraft, 141,000, 149, and then it starts reducing. So we've got to find at least 149,000. So what we always suggest is you always have to allow a bit of contingency just in case you've been over optimistic. So if you're going to go to the banks and say, can you help me with a CBILS loan, a coronavirus business interruption loan scheme. I'm going to need, will I get 200,000? Well, I would try for 200,000 in a case like this and say, I just need it just in case. If I don't need it, I can then repay it. And they'll probably do it. But even if you just say, well, I'm going to do 175, that is for 149,000 for the impact that we've seen here, 149,248, 428, sorry. And the rest is going to be contingency. And there's no problem with that. But we then have to put that figure in. So when we're coming in there and say, right, let's just say we had debt, we needed to put in a figure. We could go and put it in there and say, right, let's say in September, so we're going to have 200,000. How does that reflect our cash position? Suddenly, we've got loads of cash, 167,000, and it's reducing. So whenever you're going to put the figure in there, depending whether you've got an overdraft facility already, so it's giving us a cash flow, a contingency cash floor. So we're saying, right, okay, we're comfortable at that figure. So we put it in there, and it's reflected on our model. Now, we've got two more tabs here. Funding forecast, which is exactly what we've seen, and funding three-way forecast, which is exactly what we've been looking at. And you'll see this has already got the 200,000 in there. This is to show that maybe as a result of having that extra 50,000, maybe we might spend some more money on marketing, for example, which is going to create a bit more income. This allows us to change the figures and say, these changes are as a result of us entering in this money. So we'd leave our baseline forecasts exactly the way they were. But if we're saying by borrowing 200,000, not only are we going to put our cash flow right, but what we're going to do is spend some money. So we increase our overheads, and we then go in and put some money into spending money, say, for example, on capital, whatever. We can put it into this situation. And then what happens there is all that information gets put into a proposals. Now we've got a template here, a template with an executive summary with notes here. Now, when you print off this template, you don't have any, this bit here doesn't print. This is just for your information. So you put an executive summary, why you need the money, what's happened, what's caused it. Give them some comfort about why you need it. And again, we can help you on that. Company profile, give some background to the business, what's been good, how it's grown, etc., etc. I've just been on a session with Metro Bank, who are really keen to get in on this. They are very keen to lend money, but they all say that, don't they? But because they've got 80% guarantees on the CBILS, they're keen to get in on the CBILS because their exposure is limited. There's been lots of on the business interruption loan scheme, the 50,000. The CBILS is up to 250,000. But remember, that disappears at the end of September. Okay, financial performance, a summary of the financial performance, and then it produces automatically a whole load of information. Net profit, net worth, revenue trends. So this is just a reflection of what you've already put in your figures. Then you've got a SWOT chart, strengths, weaknesses, opportunities, threats, notes about it. So what are the strengths of your businesses? What are the weaknesses? Banks just like that because it just shows that you are recognizing your particular situation. The funding required, 200,000. Assumed term, you would have to choose here. So let's just say it's going to be 6 years. So you would then say, right, what do you want to have the money for? So you say, right, I'm going to have 150,000. 150,000. Replace money lost through COVID. 50,000 contingency. Okay, and so there's the figures. Then it says, right, performance post-funding. Is there anything that you need to explain what about your assumptions? What have you put in there that says why we've increased the sales, why we've taken the decision we have on the overheads, what the cash flow position is, the assumptions we've put in there. It's all information that the banks want to know about, and then the forecast, any extra forecast assumptions that you want to put in there, just for information for the bank. Say all these notes don't print when you come out to print it, and then you'll get your information plus the revenue forecast in graphs, all coming there, and then any additional information is there for you just to add there for completeness sake. So this, what you would normally have when you're getting to this baseline three-way forecast, you'd have a little button up here that will say press to produce the forecast. I've got it already, just to save time. I've already just got it there set up. This is how it will do, because you'll just literally get it generated as a PDF, and it will allow you to enter that information and then print it as it is for the bank. And if you don't need to go to the bank, you just simply say, well, I want to just produce a forecast so I can see what it is. And there's sensitivity analysis that, depending on the margins that you've got there, your direct costs, and all your other information that's there, but without all the funding proposal elements in there. So it's quite a detailed forecast model. And from your point of view, it's something that you can choose to use, or as much detail as you want, and just use us as backup to support you. Leslie, I mean, you've had a chance to look at it. What sort of issues have you come across?
Other than, well, there's the, for some strange reason, it's picked up some special characters when it's in the customer name, so they're not recognizable.
Okay.
But I'm sure that can be corrected.
Well, give me any feedback like that, because I'll pass that back to the developers.
Yeah, and when you talk about baseline three-way forecast, that's just with the P&L, balance sheet, and cash flow forecast stacked one after the other, right? It's not
exactly.
That's not a special new,
No,
it's a variation.
No, so there's your baseline forecast,
Yeah.
which is your history, and putting in all your information. Then you've got your baseline balance sheet, which is exactly what you've got on there. So it just allows you to know that, and then you say, right, I'm going to combine the two.
Yeah.
So it just allows you. It's giving you a summary that would appear.
Yeah. Okay.
Okay.
Yeah, and obviously, there's the. Right.
So these two tabs, the funding forecast and funding, that allows you. So it's just an alternate, another variation. That just the figures might change as a result of having the money. My figures might change, and so it allows you to go in and change it.
Right. Okay.
So you say, well, actually, if I can have the cash, my sales are going to pick up much more quickly in year 4 and in year 5. So I'm going to put 10% increase or whatever. And
the funding forecast and the funding three-way forecast are just showing the changes of actually having the money in the model.
If you choose to. So say you say, I was talking to somebody else and they said, we probably would like to have 100,000. We want extra, and we'd like to spend 50,000 of that on marketing, and that's because they're in e-marketing. They would then use that money, and they could see a definite correlation to increased sales because they're already getting big growth in America. So I said, well, that's fine. That's what this allows you to do, is to demonstrate what happens as a result of, and you can just put in your model. These are the assumptions we've used as a result of the extra money, and we put that into the forecast.
I don't know whether you're aware, but we have the American subsidiary, right? And it's also on zero. I mean, we're running it on zero here. More than half the sales. I mean, it shows our zero shows us the UK sales. And other than the royalty income from the US company, in terms of when we cross-license each other's products, it's a wholly owned 100% subsidiary of the UK company.
Yeah.
But more than, well, let's just say a third to probably 40% of the sales are in the US, and they're not reflected in our results here. And I was wondering how we could use this model to do that.
I
mean,
would use the other sales and just and enter the figures in there, but you'd also have to put in any direct costs as well, commission.
Yes, obviously.
Yeah.
Okay, so that's then that will give us the complete. Okay, so that's what's. Let me just take a note on that.
So I would literally use this bit here.
Yeah.
New customer, and just call that
okay.
USA income stream 1 or whatever the different.
Yeah. Okay. Right. Okay, and then obviously all the salary costs, rent costs, everything else that goes there into the US.
Yeah, that way it's almost like doing a consolidated.
Yeah, it is. Yeah, we're thinking we produce consolidated accounts from we dump zero for both the US and the UK, US and UK companies, and we convert. You get them in not constant currency terms, but we convert them month by month with the average end of month average exchange rate.
Yes.
And we combine them for our own management accounts here. But I suppose this is going to be a lot quicker.
Yes. Sorry, get rid of this one.
Yeah. Okay. I can see how. Yeah. What other questions? Yeah. That was the top line questions I've got. We're going to start. We obviously got you sent it over on Tuesday, so we're going to start.
Yeah, I mean, I'd be fascinated to see what practical questions like that, and if you get any funnies appearing on the screen, like you're saying hieroglyphics, let me know, and I'll speak to Mark Walker.
Yeah. We have a sort of manual version of this, which is a lot of work to keep it up to date and going. This is obviously going to be a huge time saving in terms of doing these things. So.
Yeah,
but we'll get going. We're finishing up the VAT quarter for obviously the accounts of the VAT quarter in June now. So,
okay.
But we'll get going. We'll be back to you probably early to middle of next week.
Okay, great. Taleb, did it blow your mind?
Well, I find it useful. I have not been able to follow it all up completely, I would say. However,
in your case, Taleb, for example, you've got all your different rooms.
Yeah.
Good. I can't remember at the moment. I don't think you've got your nominal structure by room number. So in theory, if you had your nominal structure by room number, you'd be able to put those down there.
Yeah.
And you could create these extra numbers down here. We could get extra numbers set up for you. But I think you've just got fee income. So,
but that's an idea. Maybe we should make a start and then do it by room numbers, because once it's done, it's going to be there on the data.
I personally like that idea. Say that by having it by room number, and I know you might get somebody. It's better than have it by room number than by name, because you at least that way you'll know, and then you're going to have some rooms that are unoccupied. That's fine, but we can then get a feel for how much each room. So where you've got your better quality rooms, you'll see the income reflected on your better quality rooms, hopefully.
Yeah. But
if I speak to Aisha and say how to structure it, then that might be a way of doing it, because you're only as good as the information you put in there.
Yeah. Mike, you were saying that you would do sort of pre-populate and enter the current data, or you go back a few years?
I can go back and load your history. So this I can interrogate it and load it onto the model. So but as I say, it's only as good as the information that's put in there. But at least it's giving you some point of reference. On it.
Yes.
So let's do that. And what I'll do is I'll send that to you, and then you can have a look at it with Aisha, and then see how you get on with it.
Yep. Thanks very much.
All right.
Yep.
Okay. Well, when I first looked at this, it blew my mind, and I sort of heard this, and I was an accountant, and I thought, my God, this is really quite common, but it's really quite a a simple model. Is we changed it, we've improved it. They've listened to us, and we're still improving it further. We're the next model. We're actually producing actual against budget, because I said, you know, running a business, this is great for theory, but I said in business we want to see our actual against
absolutely.
So they're going to produce that for us, and that's imminent. And a couple of other sensitivity analysis that we've asked to be put in. So any sort of like things on a wish list that you can see and say, well, it'd be great if only it did that. Let us know, and we'll have a look at it, because these guys are really quite switched on, and they've got a bit of funding behind them, and they're looking for us to take the software on, and we're testing it and see what we like, and we do like their approach and the support they're giving us.
Mm-hmm.
Okay.
Right.
Well, best of luck then. It's what I can say. It's Leslie's already had a go. Taleb, it's new to you, so I'll do the recording, and then we'll take it from there.
Yeah. Thank you very much, Michael.